I'm Jane. Welcome to the Attract Capital webinar series. I'm here today sitting with the CEO and founder, David Barnett.
Hi, everybody.
And we're here hoping, will the real private equity groups please stand up? So why are there so many private equity groups in the market, Dave?
Well, it's a great question, Jane. There's so many private equity groups in the market because there's been an explosion in the alternative asset category where there's been a tremendous proliferation of private equity groups. Many are funded groups that have large capital funds behind them, but a lot of them are independent sponsors who are entrepreneurs that have gotten into the business, as well as non-sponsored private equity groups, which are people that don't have money but want to find a company to buy, and then they will raise the money on the back end. So there's a lot of fundless sponsors. Fundless sponsors really didn't exist 10 years ago, 20 years ago. And so nowadays you have all sorts of people saying that they're private equity groups, but not all of them are real in terms of having capital behind them.
I'm curious then, are all private equity firms created equal?
Well, that's an even better question. All private equity firms are not created equal. There's huge differences. So on the surface, the biggest difference is some of them have a lot of capital in funds that they manage, and some of them have no capital behind them. But also some of them have vast experience in a given industry where they've invested in a lot of different companies before, and they've gone through these growth journeys. And then other people are just starting out where they might have a very highly credentialed business school degree from a Harvard or a Wharton, and they just think it's their calling in life to buy a company to deploy their entrepreneurial skills. So they're not created equal because the former have tremendous capital wherewithal as well as experience, and the latter are people that are just starting out and want to get involved in the business.
So with that being said, how do you differentiate between real and non-real PE groups?
Well, I've been in this business for about 32 years, so I'm pretty good at discerning who has capital and who doesn't have capital. And there's certain telltale questions to ask and diligence to do on each person that comes your way. And you just ask them, how much capital do you have? And, you want to know how much capital that they manage. You want to make sure that they can commit that capital. And you want to make sure that there isn't any ambiguity in their answer. Like, it needs to be a very direct answer, and most funds that have capital behind them will tell you, well, we raised this money from this endowment, we raised this money from this asset fund. So they'll kind of map it out for you because they want to build your confidence. The ones that don't want to talk about, when you ask the question and you don't get a good answer, they really don't have their hands in the money, and they're just trying to see if they can get involved in your process to buy the company and then raise it on the back end. So they need to have experience, they need to have deals under their belt, they need to have a portfolio that they manage in order to be real, in my book. It's not to say that the non-real private equity firms are not worth talking to, but they pose challenges to try to get a deal done.
Last but not least then, what is the risk of working with a non-real equity group?
So a non-real equity group, if we're going to say non-real equals a fundless sponsor, is that they can't raise the money. And if you've decided, think about it, like you're selling your company, which is a life's worth of work, to somebody that doesn't have the money to be able to close the deal. Like, it sounds insane.
That's insane.
But people that are credible, that have a strong track record, might be able to raise money easily from people that believe in them. They'd rather sign up the deal and then go to the people that believe in them and then raise the equity that way. But in not having the money up front, it adds risk to the process. And you never know if they're going to be able to raise the money. So you could waste a lot of time, you could waste a lot of energy. And a lot of the non-sponsored funds are rookies, frankly, and they don't realize how inexperienced they come across when they're talking to you. Because, like, if you want to look at one of my deals at Attract Capital, you need to be funded.
Yeah.
We don't really want to deal with people that are not funded because it's not worth our time, is sort of how we look at it. So the risk is that the deal doesn't close, which is a very big risk.
That is a big risk. Thank you so much, as always, for taking the time to explain these details to us. If this inspired any more questions, if you'd like to learn any more from us, contact us directly, and we'll see you next time.
Take care.